Joining us now is Jessica Reif Ehrlich, BofA Security Senior U.S. Media and Entertainment Analyst. And we'll keep it to subjects other than that. I understand, Jessica. There's a lot of assumptions you would have to make about the culture wars and what happens with this Disney board. And I don't know how you factor that in to deciding what to do with Disney stock. That's why I don't know if I'd comment or if I'd want to try to figure that out either. There's just too many variables. So we'll stick to the fundamentals of the business itself. You'd prefer that.
Okay, although I will just say that I think Bob Iger has handled himself incredibly well since he's back. He's dealt with a lot of distractions. And even at the shareholder meeting yesterday, there were some pretty antagonistic questions, and he treated everybody with respect. So, doesn't sound to me like he's putting fuel on the fire. I heard in Florida, I heard your comments earlier. But he has a point of view, and he said it very respectfully. Exactly.
But with that said, now the hard part probably begins. The theme park's a bright spot. Theme parks, I guess.
Yes. Theme parks have been packed. It's obviously a rolling spring break. But the demand for, Disney products, particularly the theme parks, has, post-COVID, has surprised everybody. And it feels like this is a multi-year run. Typically, when there's a downturn, whether it's COVID, 9/11, or, like a major recession, or gas crisis, whatever has happened in the past, there's a 5 to 10 year period of growth. And Disney has a lot. They're besides the park itself, they're growing, they're adding attractions, they're adding cruise ships, and it almost seems insatiable demand from consumers.
A lot of people point out that just the stock price itself, and was that a pandemic bubble or a Disney Plus streaming bubble? It is a long way from the highs, from $190 a share.
Absolutely. This company, Bob Iger came back to a company that has many challenges, and he's, kind of dealt with the distractions so he can focus on improving the company. And there's a lot to do. There's a lot to fix: the film division, the profitability of Disney Plus, some of the strategic issues that they face, whether it's Hulu or ESPN. So he's, kind of tackling it one by one, restructuring the company, but it will take some time.
It's just it seems like a good problem to have. You can all tie it back to expectations for streaming, I guess. Disney Plus was going to grow forever, and who knows about profitability necessarily for it. Hulu looked like whoever was going to eventually get it was going to be in the catbird seat. Now it's like a hot potato almost. So the world changes so quickly. But what I don't understand is the content is still king. So it's got to be, if people are cutting cords and people are weeding out streaming services they don't want, what is the survivor? What's the winner? What does the future look like for delivering content, and who's going to do it?
There will be a few diversified services, and I think that the comments that Bob made earlier in the year about general entertainment may be confusing. So it sounds to us like they're not. The Hulu is a put call with Comcast, and it seems like Disney will buy it. But it's not like they're walking away from general entertainment. Their service needs to be a little bit more diversified than just the Disney Plus brand, the Disney brands. It just sounds like they will do less. They don't need as much content and maybe spend a little less per show. But they will, of course, have general entertainment to attract all 4 quadrants. So what is a profitable streaming service? I think you have to deal with pricing. And Disney has introduced an ad tier, and we have yet to see the benefits of that. They've increased their price in the U.S. by 38%, in early December. So we still have the benefit of that to come. And then, of course, there's just the cost realignment, and that will take some time, because what's in production is in production. But that will take some time to execute. So it's a combination of really driving revenues, which they're doing, again, from subscription and advertising, as well as, kind of cutting or restructuring that cost base.